Looking for a simple way to build long-term income without spending much? With just $14 a week, you can grow a portfolio that may pay around $2,800 a month. It's possible, and I'll show you how. In this video, I'll show you and John simple and practical tips that investors keep secret. I'll show you the DRIP strategy and how you can make it even better with weekly investment. And in the end, I'll show you how, using this strategy, you can turn a $14 per week investment into a portfolio that pays you $2,800 in monthly dividends. But before any of that works, you need a strategy. Real passive income isn't just about putting money into the market, it's about using a system that makes small weekly deposits actually matter. When your target is something as meaningful as $2,800 a month, guessing your way forward won't get you there. You need something steady, something that keeps growing even when you're busy living your life. That's where DRIP comes in. It reinvests every dividend for you automatically, turning tiny payouts into more ownership without any extra effort on your part. And once you understand what DRIP is really doing in the background, the rest of this strategy starts to make a lot more sense. So let's break down exactly how it works. DRIP stands for Dividend Reinvestment Plan, and it does something surprisingly simple. Instead of paying your dividends out as cash, it automatically uses them to buy more shares of the same investment. This steady increase in share count is what allows your investment to grow faster over time. The main benefit of DRIP is that those additional shares generate dividends as well. This creates a step-by-step expansion that builds on itself. You don't see dramatic jumps early on, but the growth becomes more noticeable as your share count compounds year after year. To really see how DRIP works, let's walk through a clearer example with real numbers. Let's say you start with a $1,000 investment. The share price is $20, so you begin with 50 shares. The dividend yield is 5%, which means each year you earn 5% of your investment back in dividends. Nothing complicated, just a steady payout based on what you already own. In the first year, your 50 shares earn 5% in dividends, which comes out to $50. With DRIP turned on, you don't take that $50 as cash, it immediately buys more shares, let's say at the same $20 price. That adds 2.5 new shares to your account, bringing your total to 52.5 shares by the end of year one. And because each share is still worth $20, your investment value at this point is now about $1,050. Yeah, it's not a huge jump, but the important part here is that next year, every one of those shares earns dividends too. Now let's look at year two. You're starting this time with 52.5 shares instead of the original 50. At the same 5% yield, those shares earn about $52.50 in dividends. And again, DRIP takes that $52.50 and automatically buys more shares for you. At that $20 share price, that adds another 2.62 shares. So by the end of year two, you now hold about 55.12 shares, and your investment is now worth roughly $1,102.50. By year three, this compounding becomes easier to notice. You now start the year with roughly 55.12 shares. At a 5% yield, those shares earn $55.12 in dividends. DRIP puts that right back into new shares, adding another 2.76 shares to your total. So at the end of year three, you're sitting at about 57.88 shares. And at the same $20 price, your investment value has grown to around $1,158. It's the same money you started with, but now it's worth more. What's interesting here is how the numbers slowly push themselves upward. Your dividends went from $50 in the first year to $52.50 in the second, and then to $55.12 in the third. Nothing changed about the yield. You didn't add any new investment. The only thing increasing is your share count. And that's purely because DRIP keeps turning every dividend into more ownership. This is the core idea behind DRIP. Your investment keeps adding tiny amounts of growth that stack up on top of each other. Another underrated benefit of DRIP is discipline. DRIP buys shares for you whether prices are high or low. When the market dips, your dividends pick up more shares. When prices climb, they pick up fewer. Over time, this evens out your costs and keeps emotions out of the way, which is something even experienced investors struggle with. The whole system also runs on autopilot. Once DRIP is on, you're not deciding when to reinvest or wondering whether now is the right time. It just keeps growing in the background while you go on with your life. And that consistency matters more than most people realize. Now, in the end, I'm going to show you how this DRIP strategy can turn a small investment into a portfolio that pays you $2,800 per month. But for that, you need to improve this DRIP strategy. Here's how you can supercharge the DRIP investing strategy: by contributing a set amount every week, month, or year. Instead of relying only on reinvested dividends, you add a small amount of money on a regular schedule. For this video, I'm using just $14 per week. That's roughly $56 to $58 a month, or about $730 a year. And even though the amount seems tiny, the long-term impact is surprisingly strong. By putting in $14 every week, you're speeding up the rate at which you collect new shares. Instead of waiting for dividends to do the work on their own, you're adding fresh money that keeps your share count growing faster. And every share you pick up starts earning dividends right away, which means DRIP has more to reinvest for you each cycle. Regular weekly deposits also help you take advantage of dollar cost averaging. Since you're buying shares all year long, sometimes at higher prices, sometimes at lower, you avoid stressing about whether now is the right time to invest. Over time, your average cost smooths out naturally. And because $14 a week is small enough to fit into most budgets, it becomes a habit instead of a struggle. Once the routine is in place, DRIP takes care of the rest. Every dollar you invest stays inside the system, reinvests itself, and keeps adding to your ownership without you having to even think about it. From here, the next step is choosing the right kinds of stocks that actually make this strategy work over the long run. Now, not every stock is a good fit for DRIP. Since your dividends automatically buy more shares, you want companies that are steady, dependable, and able to grow both their earnings and their payouts over time. 4 categories stand out as the strongest foundation for any DRIP-focused portfolio: blue-chip dividend stocks, dividend aristocrats, high-yield dividend stocks, and growth-oriented stocks. Blue-chip dividend stocks are a popular choice for DRIP investors. These are reputable companies with long histories of consistent dividend payments, indicating financial stability and reliability. Examples include Coca-Cola, Johnson & Johnson, Procter & Gamble. Starting with blue-chip stocks gives your portfolio a dependable base because these companies have proven their ability to generate steady income and reward shareholders over many years. Secondly, dividend aristocrats are another essential category. These are companies that have increased their dividends for at least 25 consecutive years, showing a strong commitment to returning value to shareholders. Aristocrats help stabilize your long-term strategy since their long history of increases makes them far less likely to cut dividends, even during challenging market periods. The third group is high-yield dividend stocks. These stocks pay more upfront, which gives your DRIP system more income to reinvest right away. Companies like Realty Income, AbbVie, and Verizon fall into this category. They do come with a bit more risk, but the higher payouts can speed up how quickly your share count grows. Lastly, growth-oriented dividend stocks combine rising share prices with steadily increasing dividends. These companies often have strong long-term prospects and continue rewarding shareholders as their earnings grow. These stocks may offer lower yields, but their consistent dividend increases and appreciation add another layer of compounding to your portfolio. When you mix these 4 types together, you get a balanced DRIP portfolio that grows through reinvested dividends, steady appreciation, and consistent increases in payouts. Each category does something different, but they work even better as a team. So, based on everything we just covered, I've narrowed the choices down to 5 stocks that work really well together and give this strategy the momentum it needs. The first holding is SCHD. It's an ETF made up of high-quality dividend companies, which means you get strong dividend growth, a reliable yield, and built-in diversification all in one place. Then there's AWR, a water utility with one of the longest streaks of dividend increases in the entire market. It's steady, boring in the best way, and adds a layer of long-term stability. CWEN brings a higher yield and faster dividend growth, which helps strengthen the reinvestment side of the strategy. Those bigger payouts add fuel to your drip cycle early on. KR offers dependable cash flow and steady dividend increases, making it a solid defensive pick. And finally, AMGN brings strong dividend growth supported by long-term earnings power in the healthcare space. Separately, their current dividend yield, dividend growth, and share price appreciation look something like this. Now, the next step is to find the portfolio's dividend yield. We start by looking at the dividend yield of each stock on its own. In this case, SCHD has a yield of 3.84%. AWR is at 2.72%, CWEN is at 5.01%, KR is at 2.12%, and AMGN is at 2.79%. Since we're giving each of these 5 stocks an equal weight in the portfolio, we can treat them all as equal parts of one simple average. So the next step is to add all of those yields together. You take 3.84 plus 2.72 plus 5.01 plus 2.12 plus 2.79. That total comes out to 16.48. Now, because there are 5 stocks in the portfolio and we're weighting them equally, you divide that total by 5. When you do that, you get 3.296. That number is the average dividend yield of the portfolio. If we round it to 2 decimal places, that becomes 3.3%. And that is how we arrive at a portfolio dividend yield of 3.3%. You can follow this exact same process for the dividend growth rate and the annual share price appreciation as well, using their individual numbers and averaging them the same way. When you do that for this portfolio, you get a dividend growth rate of 11.78% and an annual share price appreciation of 6.94%. Now, the real question is whether this portfolio can grow enough over time to eventually pay you around $2,800 every month. To see that, let's walk through what happens when John puts in just $14 each week. By the end of year 1, John would have invested $730 in contributions. This sets the stage for future growth. After 10 years, that steady weekly investing grows the portfolio to about $12,422. This is where DRIP and those small contributions begin feeding into each other, slowly building momentum. By year 20, the effect becomes much more noticeable. The portfolio is projected to reach roughly $58,360, and a big part of that growth is coming from the reinvested dividends. Push it out to year 30, and the results look completely different. Those same $14 weekly deposits grow into a portfolio worth about $310,924. And at that point, the dividends alone are paying around $33,608 a year, which comes out to about $2,801 every month. Altogether, the portfolio adds $289,024 in gains on top of John's original weekly contributions, which adds to about $21,900. Roughly $115,842 of that gain comes from share price appreciation, and the other $173,182 comes directly from reinvested dividends. Want to know how a simple $5 a day investment can grow into a portfolio that pays more than $8,000 a month in dividend income? Click the video on the screen to find out.